and welcome to the Monday Futures Market Outlook for November 28th, 2011. This is Patrick Serezna. For those of you that have not had the opportunity to try out the eMoneySource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. Does a very good job to depict the bull and bear market cycles that we've gone through. We've been flatlining right on that moving average over the last 3-4 months with numerous penetrations above or below, typical of a very range-bound price action. At this stage, the market has yet to show its hand as to whether it has the intentions of running higher or lower. We just have to wait for a little further clarity over the next few weeks before we make a commitment. It would be a legitimate breakdown below that 1100 level on the downside that would really solidify a new downtrend. Just to make some key intermarket observations, Friday was a critical day from an intermarket perspective. The US dollar was reaching its previous highs for a double top retest. We had treasury bonds and 10-year and 30 years both coming up to critical overhead resistance levels and creating retests of those highs. And many commodities were testing their retracement zones down below at the same time as the S&P 500 was testing a critical zone in that 1150, 1160 area. This morning, all of those markets have reversed off those critical support resistance levels. Now, that is optimistic for the markets, but we need to see follow through early this week. If we do, then this is technically a perfect place for there to be a significant reversal on the markets here. So we don't want to rush off to make any conclusions that that was it. But if we see positive follow through, the markets should try to advance in a way that won't allow a lot of people to get in. So expect that if this is going to be a reversal, that it's going to be very fast and leave a lot of people feeling like a deer in headlights as the market reverses off that point. Next year, when we take a look at the S&P 500, we've been talking about a declining wedge all along. We were looking for support levels to even hold in that 1160, 1180 area, but the 1150 area is where the home of like a 61.8% retracement lied. So in fact, there was some critical support still below. And again, so long as all the other markets are reversing, we still can't rule out the possibility that this is where the low swing low is going to be before a market actually does a very bullish year-end rally going into January, February of next year. Now again, we don't want to rush off to make this forecast. There has to be substantial follow-through on this morning's price action, but the way I'd look at it is this: so long as that 1150 level holds on the downside, then this still represents a very good risk reward proposition to buy. If the 1150 area gives out on the downside, we'd have to go and consider a number of far more bearish scenarios. Next here, I want to take a look at the US dollar index futures, and this is going to be a crucial piece of information from that intermarket perspective. If in fact the US dollar just did a retest of those previous highs, and if that separating line reversal that we saw there with the red reversal bar on the downside is confirmed with a breakdown, if this would obviously have to occur with strength in a number of global currencies, particularly even the euro, if we see that breakdown move in the dollar index moving down to 78 or 77 on the downside, that would really spark that follow through in the markets. Next, when we take a look at the commodities like copper, has been creating this declining wedge on the downside, also respecting some of the retracement zones coming to crucial levels. Obviously, commodities have a very strong inverse correlation to that US dollar. So if that US dollar does weaken, there's room for copper to still make a bullish breakout here. Again, it's still too early to make any assumption off of just this morning's price action, but so long as we see over the next day or two copper strengthen above 340, 350 on the upside, it would be some positive signs that in fact a short-term swing low on copper may be in place. Again, let's just see how the early part of this week follows through. Next here I want to take a look at crude oil, and crude oil has been actually holding up very, very well throughout all of this, and in spite of that massive rally, we were looking for pullbacks that could have even gone all the way down to the 90-92 level on the downside, but very quickly today we see a very bullish breakout candle on crude oil off of this little shallow flag. As far as I'm concerned here, it will be absolutely crucial to see what crude oil does over the next day or two, especially around this 101 to 103 level. If crude oil can break to a higher high, we could see $10 tacked on very quickly as we go for a retest of the highs from April and May up around the 113, 115 level. So let's just see whether crude oil can actually make a breakout stick here. Next I want to take a look at gold futures, and gold also has been putting together that declining wedge that came right into the retracement zones. We basically have been using that 1700 level sort of as a pivot, being bearish below and bullish above, and I don't see anything different in this scenario. This wedge would have a very bullish breakout if price action continues to hold above the 1730 level. If we see gold strengthening at this level, we have to consider the scenario that gold may in fact turn bullish again, and actually maybe even make a gun for those 1900 highs, doing a measured move higher. At this stage, again, we don't want to be rushing off to be bullish just yet, but recognize that if crude oil, copper are all bullish at the same time as US dollar is weak, it would certainly allow the environment to be ripe for gold to make a bullish breakout. Finally, I want to take a look at that 30-year Treasury bond, and this is a crucial piece of information because the Treasury bonds have now retested those highs and have put in 2 solid reversal days. These 2 reversal days on the downside of Treasury bonds is important because there's been a direct inverse relationship of bonds to stocks, and if in fact the Treasury bonds here fail at these upper levels and begin any substantial weakening on the downside, this weak Treasury bond market will have money rotating out of bonds and into stocks, and could be the fuel that runs a year-end rally. So we're going to be watching very carefully whether or not these 30-year Treasury bonds do reverse, and if they do, it would certainly mark some very important intermarket shifts. That was your Monday Futures Market Outlook. Thank you for joining me.